The teller is smiling at you. She has been smiling for about 45 seconds now, and the smile has not changed, and that is the part that should terrify you. You walked in to withdraw $22,000. You have it. It is in your account. You can see it on the screen she is looking at right now. And she says, very politely, very professionally, that there will be a hold on those funds. She cannot tell you exactly when the hold lifts. She cannot give you a written reason right now. She can give you a pamphlet. She slides it across the counter like she is offering you a mint. Welcome back to Canada Property Watch. In our previous investigations, we dismantled the self-supply HST trap that is quietly eviscerating new construction landlords across Ontario. And before that, Hudson, we exposed how the CRA's data surveillance infrastructure is matching your renovation receipts to your principal residence exemption claims in real time. Today, we are going inside a mechanism that most Canadians do not know exists until it has already been used against them. It is called a withdrawal hold. It is completely legal. It is used by every major Canadian financial institution. And in 2025 and 2026, as mortgage stress, fraud investigations, and cross-border payment scrutiny have all intensified simultaneously. These holds are being triggered at a rate that regulators are not publicly advertising. This is not a horror story about someone else. This is the operating procedure of the institution that holds your money right now. And by the end of this video, you are going to understand exactly when they can delay your cash, what they are looking for when they do it, and what you absolutely must document before you ever need a large sum of money on a deadline. Let's start with the foundational legal reality, because this is Canada Property Watch, and we do not deal in rumor. We deal in the precise mechanics of how systems execute on people who are not paying attention. Canadian banks operate under the Bank Act and the Proceeds of Crime, Money Laundering, and Terrorist Financing Act, commonly referred to as PCMLTFA. These two pieces of legislation working together give your financial institution an extraordinary and largely unchecked authority to delay, review, and in some circumstances completely freeze your access to funds that are legally yours. The hold is not the same as a freeze. A freeze requires a court order or a direct CRA Jeopardy order. A hold is discretionary. The bank can initiate it unilaterally, internally, with no judicial oversight required at the moment of execution. You are not notified in advance. There is no appeal process that runs in real time. By the time you are standing at the counter or staring at a declined e-transfer, the decision has already been made by a compliance algorithm ratified by a human compliance officer and entered into a system that your branch manager does not have the administrative access to override. That last sentence is worth sitting with. Your branch manager, the person smiling at you, the person whose handshake you remember from when you signed your mortgage, cannot override a compliance hold. They can escalate it. They can flag it for review. They cannot lift it on the spot. Now, here is where the paranoia becomes mathematically justified. Banks in Canada are required by FINTRAC, the Financial Transactions and Reports Analysis Centre of Canada, to file suspicious transaction reports, or STRs, whenever there are reasonable grounds to suspect that a transaction is related to proceeds of crime or money laundering. The critical word there is suspect, not know, not prove, suspect. The threshold for initiating a hold is even lower than the threshold for filing an STR. The compliance team does not need to believe you are a criminal. They need a pattern that their system has flagged as requiring review. And the patterns that trigger these flags in 2025 and 2026 are dramatically broader than they were 5 years ago. Here is what is actively triggering withdrawal holds right now across Canadian financial institutions. The first trigger is large cash withdrawals that do not align with your account's historical behavior. If you have had a checking account for 11 years and the largest single withdrawal you have ever made is $4,000, and you walk in one Tuesday and ask for $18,000 in cash, that request goes into a pattern recognition system before the teller has finished typing it. The system is not judging your character, it is comparing your behavior against your own baseline. A deviation of that magnitude, particularly in cash, is an automatic flag. The second trigger is large deposits immediately followed by large withdrawal requests. This is the pattern that is eviscerating real estate investors right now. And this is where Canada Property Watch needs you to stop and really pay attention. The BRRR model, buy, renovate, rent, refinance, became the operating theology of amateur Canadian real estate investors between 2018 and 2022. The refinance step typically involved a large deposit from one institution hitting a checking account, followed very quickly by a wire transfer or bank draft to a lawyer's trust account for a new acquisition. That movement, large deposit in, large withdrawal out within a compressed window, is structurally identical to a layering pattern in a money laundering scheme. The bank's compliance algorithm does not know you are buying a triplex in Brampton. It knows a large sum arrived and you immediately want it to leave. And in 2025, with regulators having publicly identified the Canadian real estate sector as a primary vehicle for money laundering, this is documented in FINTRAC's own typologies reports. The algorithm sensitivity has been calibrated upward. Holds that would not have been triggered in 2020 are being triggered now on the same type of transaction. Stay with me. This next part changes everything about how you think about your own money. The third trigger is real estate transaction adjacency. If your account has recently been involved in a property purchase, a mortgage drawdown, or a refinance, you are in what compliance departments internally classify as an elevated scrutiny window. This window can last anywhere from 30 to 90 days post-transaction, depending on the institution. During this window, and with any unusual cash movement, any request that deviates from your baseline is reviewed with a heightened sensitivity threshold. You do not receive a letter informing you that you are in this window. You will not find it described in your account agreement in plain language. It is an internal operating procedure. And if you walk in during that window and try to withdraw a large sum, you are going to find out about it in real time, at the counter, with a teller who has been trained to remain calm and give you the pamphlet. The fourth trigger is Interac e-transfer patterns involving multiple recipients, particularly in amounts that cluster just below $10,000. $10,000 is a critical threshold because cash transactions above that amount trigger mandatory FINTRAC reporting. The compliance systems have long since been updated to recognize structuring, the practice of breaking large transactions into smaller ones to avoid that threshold. Multiple e-transfers of $8,000, $9,000, $9,500 sent within a short window to different recipients is a textbook structuring pattern. Even if every dollar is completely legitimate, rent collection, loan repayments from family members, proceeds from selling a car, the pattern itself is enough to trigger a hold and potentially a suspicious transaction report filed without your knowledge. Now let's talk about what happens during a hold, because this is where the collateral damage extends far beyond inconvenience. When a hold is placed on your account, it does not necessarily mean your entire account is frozen. Now, a targeted withdrawal hold can be applied to a specific transaction while the rest of your account continues to function normally. You can still have your payroll deposited, your pre-authorized mortgage payments can still process, but the specific funds you requested, or in some cases, a specific tranche of your balance, are flagged and inaccessible. The hold period under most Canadian bank policies runs initially from 3 to 7 business days for standard review. If the compliance review escalates, meaning a human officer reviews the file and determines that additional investigation is warranted, that hold can extend to 30 days. And if the bank's investigation results in a referral to FINTRAC or a law enforcement disclosure, the funds can remain held pending that external process, one which operates on its own timeline entirely outside the bank's control. Here is what this means in practical terms for over-leveraged real estate investors. If you are managing a portfolio of properties and your cash flow is tight, which in 2025 and 2026, with mortgage renewals hitting at dramatically higher rates, describes an enormous proportion of Canadian landlords. A 7-business-day hold on a large withdrawal can be catastrophic. A contractor waiting for a final draw payment walks off a job. A mortgage payment misses its processing window. A property tax installment bounces. Each one of these events creates a cascading paper trail that is now being read by underwriters, insurers, and the CRA's analytics platform simultaneously. And here's the piece that should keep every over-leveraged investor completely awake. A hold does not stay internal. Financial institutions in Canada have a legal obligation to file a suspicious transaction report with FINTRAC if they determine there are reasonable grounds to suspect money laundering or terrorist financing. The STR is filed confidentially. You are not informed that one has been filed against you. You cannot access it. You cannot rebut it. It enters a federal database where it sits until the analytical threshold for investigation is crossed. And in an environment where FINTRAC's 2024 and 2025 reporting has specifically identified Canadian real estate as a high-risk sector, those thresholds have been recalibrated significantly downward. An STR filed against your account today is not an isolated incident. It is a data point that lives in a federal system, potentially linking your name to a pattern that you do not know exists for an indefinite period. Quick question for you right now. Has your bank ever delayed one of your transactions without a clear explanation? Type A if yes, B if no. Real data from this channel's audience helps shape the next investigation. Let's move now to the CRA dimension, because this is where a withdrawal hold stops being a bank compliance issue and becomes something considerably more permanent. The CRA has a mechanism called a Jeopardy Order. Under Section 225.2 of the Income Tax Act, the CRA can apply to the federal court on an ex parte basis, meaning without notifying you in advance, for authorization to collect taxes immediately if they have reason to believe that collection would be jeopardized by delay. This is not a warning. This is not a notice of assessment that you have 90 days to dispute. A Jeopardy order can be authorized, delivered to your financial institution, and your funds can be seized before you receive any notification at all. The standard collection procedure under the Income Tax Act normally allows a taxpayer to object and appeal before collection action begins. A Jeopardy order surgically removes that protection, and critically, the information that can trigger a Jeopardy order application includes STR data that FINTRAC shares with the CRA under the Proceeds of Crime Act's information sharing provisions. The hold your bank placed on your account and the STR they filed without telling you can become the predicate for a federal court order that reaches back into your accounts before you have had a single conversation with a CRA auditor. This is not a hypothetical legal chain. This is the documented enforcement architecture of the Canadian federal government. Every single link in that chain is real, and the investors who built their portfolios during the boom years on the assumption that cash is private, that Interact transfers are invisible, and that a corporation structure provides insulation from personal liability. Those investors are the specific demographic this system was recalibrated to target. Here is what you absolutely must document, because this channel exists not just to show you the mechanism, but to give you the precise, practical response. First, document every large transaction in writing before it occurs. If you are withdrawing a large sum, have a written record of the legitimate purpose, a signed contract, a lawyer's letter, a purchase agreement, and ensure that record is dated prior to the withdrawal request. The bank's compliance team is pattern matching. A documented purpose does not eliminate a hold, but it dramatically compresses the review window because the compliance officer has a legitimate narrative to close the file against. Second, communicate the purpose to your banker proactively in writing before you appear at the branch. Send a message through your bank's secure messaging portal. Not a phone call, not a conversation, but written documentation with a timestamp, stating the purpose, the amount, and the date. This creates a communication record that lives in the bank's file. If the hold is placed and you later need to escalate, this record is your first exhibit. Third, if a hold is placed and you need to escalate, do not argue with the branch manager. Request a written explanation of the hold in writing via the bank's secure messaging system. The bank is required, under the Financial Consumer Agency of Canada's complaint handling framework, to respond to written complaints. A written hold explanation, even a vague one, starts a documented timeline that matters if you ever need to pursue a formal complaint or involve a financial ombudsman. Fourth, If you have a real estate portfolio and you are managing transactions that could pattern match to layering, montage deposits in, withdrawals out, compress timelines, restructure the timing, build a deliberate gap between the receipt of funds and the withdrawal or transfer, maintain a written ledger, separate from your bank records that documents the source and destination of every large transaction. Not because you are doing anything wrong, because you need to be able to demonstrate in 30 seconds or less, with documentary proof, that your pattern is legitimate. The compliance algorithm has already made a judgment. The compliance officer who reviews the flag is looking for a reason to close the file. Give them one. Fifth, understand your rights under the bank's hold funds policy. Canadian banks are required to disclose their hold funds policies. Ask specifically about Regulation E equivalent notice timelines under your institution's policies. But ask for the specific written policy that governs withdrawal holds for existing customer funds, not deposit holds, which are a different mechanism, and retain a copy. Now, I want to speak directly to the viewer who is watching this and thinking this does not apply to them because they have done nothing wrong. This is the most important thing I will say in this entire video. The compliance system does not punish wrongdoing. The compliance system identifies deviation from expected patterns and initiates review. If your financial behavior has changed significantly because of the real estate market, because you are selling an investment property, because you received a large insurance payout, because a parent transferred funds to you as part of estate planning, you are producing exactly the kind of transactional deviation that gets flagged. The system will review you with the same algorithm it uses to review the investor who has been fraudulently inflating rental income for 4 years. The outcome of your review will be different, but the initiation of the review is mechanical and indiscriminate. Drop this in the comments right now. Documented. If you already keep written records of your large transactions, or starting now if this is the first time you have ever thought about this. This helps us understand who is watching and what the next investigation should focus on. The 2025 and 2026 environment has created a specific and brutal collision. Mortgage renewals are forcing a wave of property liquidations. Property liquidations are generating large, unusual cash transactions. Large, unusual cash transactions in real estate adjacent accounts are being flagged by compliance algorithms that have been specifically sensitized to the real estate sector. The holds are triggering STR filings. The STR filings are feeding into FINTRAC's analytical database, and the CRA is sitting on the other end of that database with Jeopardy Order authority, a newly funded audit division, and a mathematical certainty that unreported gains exist across the portfolio. This is not a system designed to punish. It is a system designed to collect, and it is operating at full speed right now in Q2 of 2026, while most over-leveraged investors are focused entirely on finding a buyer, not on the parallel federal process that has already begun. The people who will survive this, not just financially, but legally with clean credit and unencumbered futures, are the ones who understand that the documentation they create today is the only thing standing between them and a Jeopardy order that arrives before breakfast. The teller is still smiling, the pamphlet is still on the counter, and somewhere in a compliance center, a flag is waiting for someone to review it. What you do next is either going to give that reviewer a reason to close the file, or it is going to become Exhibit A. 2 paths for the next investigation, and I want you to choose. Vote in the comments, then type CMHC if you want us to break down exactly how CMHC's fraud database permanently blacklists borrowers from insured mortgages after a compliance event. Or type garnish if you want the full mechanics of CRA wage garnishment after a deficiency judgment, what they can take, how much, and how long. The next video goes to whichever one this audience chooses. Subscribe and hit the bell so you are there when it drops, because that video is going to answer the question that nobody in this space is willing to ask out loud.